The NVIDIA stock is currently trading at $198.69, marking a significant intraday movement, down $8.19, or minus 3.96% as of the latest market data from the NASDAQ exchange on November 5, 2025. This move is a sharp correction, pulling the stock back from its recent all-time high territory and pushing it firmly into the high end of its daily range, having traded between a low of $197.93 and a high of $203.97 today. The prevailing expectation, driven by the unprecedented growth in AI infrastructure spending, is that NVIDIA's ascent is practically unstoppable, and any dip should be bought aggressively, reflecting the general confidence in the AI narrative. However, the reality of this nearly 4% drop points to something much more nuanced, a genuine, technical profit-taking event layered over increasing macroeconomic anxiety and very rich valuations that are finally hitting some friction even in the must-own AI space. This isn't just noise, it's a necessary, though painful digestion of the massive gains seen as the company crossed the $5 trillion market capitalization milestone just last week. The question isn't whether the long-term thesis is broken, it almost certainly is not, but rather whether the recent valuation multiple had gotten ahead of the near-term delivery schedule, creating a vulnerability that the broader market weakness is now exploiting. The core belief about NVIDIA stock is that it holds a quasi-monopoly on the computational infrastructure of artificial intelligence. Its data center GPUs, particularly the Blackwell and the upcoming Rubin families, are considered essential for every major cloud provider and enterprise AI initiative, securing hundreds of billions of dollars in future revenue. This narrative is certainly well-founded. The company has even publicly stated it has visibility to fulfill a staggering $500 billion in orders between 2025 and 2026. This level of order backlog would be unbelievable for almost any other company, yet it's the expected baseline for NVIDIA. The contrarian take, the deeper reality, lies not in questioning the demand, but in scrutinizing the rate of that demand's conversion into earnings, particularly against a 50+ PE ratio. The current sell-off, with high trading volumes of over 188 million shares today, suggests a critical reevaluation of how quickly the company can ramp production of its Blackwell chips, an element analysts are now paying close attention to. Recent stock movement has been a volatile mix. Following the impressive surge to the $5 trillion market cap, driven by a highly bullish $350 price target from one institution and a more conservative but still strongly positive $240 target from Jefferies, the stock seemed to be in constant breakout mode. The initial reaction to the pre-earnings news, where analyst firms reiterated their confidence based on the $500 billion order book visibility, created a short-lived euphoric spike. However, today's pressure is systemic. The broader market, specifically the NASDAQ, is feeling the weight of inflation concerns and the potential for a sticky interest rate environment, leading to a general de-risking in high-multiple growth names. When that happens, even a titan like NVIDIA Corp gets pulled down. Institutional activity, which drives this stock more than retail flows, shows a mixed picture. While the 13F filings from the previous quarter indicated a high level of accumulation, with institutions holding over 75% of shares and increasing their portfolio allocation to the stock, the daily volume suggests some heavy rotation or trimming is occurring at these lofty price levels. A few key institutional investors are subtly stepping back, locking in profits after an incredible run, signaling that even the smart money is seeing the immediate peak of enthusiasm challenged by prevailing market currents. This isn't panic, but rather a tactical adjustment that a self-investing brokerage account user might be wise to heed, whether they use the services of Fidelity, Robinhood, SoFi Invest, or the advanced tools of interactive brokers. Understanding these institutional selling waves is crucial for anyone engaging in online investment or self-investing. When we look beyond the daily churn, the business model of NVIDIA Corp is essentially a lock and key system. The key is the hardware, the graphics processing units, GPUs, that are orders of magnitude better at parallel processing than traditional CPUs, making them ideal for the intense matrix math of AI model training. The lock is the software platform CUDA. CUDA is a proprietary parallel computing platform and programming model that has cultivated a massive, sticky developer ecosystem over 2 decades. This dependency on CUDA is what makes competitors, even those with technically good hardware, struggle to gain a foothold. The customer isn't just buying a chip, they are buying an entire optimized software stack that has become the industry standard for AI software development. This is why their data center segment continues to be the primary engine, posting staggering growth figures like the 112% year-over-year increase reported in Q3 fiscal 2025. Gaming, the company's original core business, is still a significant revenue stream, but it now plays second fiddle to data center. Professional visualization and automotive, while smaller, are crucial for future diversification, particularly in the robotics and autonomous vehicle spaces where the need for real-time on-device AI inference is growing rapidly. Older reports confirm this consistency of the narrative. For example, Q3 FY25 revenue at a record $35.1 billion, and non-GAAP EPS was $0.81, both handily beating estimates, driven almost entirely by the data center segment. This is the foundation upon which current expectations are built. However, the true tension lies in the company's valuation metrics. A P/E ratio approaching 60 is not for the faint of heart. It prices in years, if not a decade, of hypergrowth. This is where a user of an intelligent portfolio or Schwab Intelligent Portfolios might see a red flag, as such systems tend to favor more balanced, value-oriented holdings. Yet, the argument from the bulls is that in a paradigm shift like AI, traditional valuation metrics are insufficient, and you're buying into the growth of the entire industrial infrastructure, not just a single company's product cycle. This perspective often leads to a strong long-term conviction, which is essential for online investing in a volatile stock like this. The future outlook for NVIDIA stock is dominated by several key catalysts and risks. On the upside, the primary catalyst remains the full ramp-up of the Blackwell platform. Its performance promises to be another step function improvement, virtually ensuring that the company maintains its technical lead over AMD and Intel for the foreseeable future. Strategic partnerships, such as those with major cloud providers like Amazon, Microsoft, and Google, as well as the significant investment in international AI clusters like the one with Hyundai in South Korea, create durable revenue streams. The push into sovereign AI, countries building their own domestic AI supercomputers for national security and economic reasons, is an incredibly large, untapped market where only NVIDIA Corp currently has the scale to deliver the necessary solutions. Furthermore, the expansion of the software ecosystem through platforms like Omniverse for digital twins and robotics promises to extend their hardware advantage into sticky, high-margin services, fundamentally shifting the business model to a platform play, much like Apple stock has done with its services segment. The risks, however, are tangible and are what the market is reacting to today. Geopolitical tensions, particularly concerning access to the China market, continue to overhang the stock. The company has explicitly had to design less powerful chips to comply with export restrictions, and any tightening of those rules could immediately cut off a multi-billion-dollar revenue opportunity, forcing a significant revision of consensus estimates. Competition, while currently trailing, is a constant threat. AMD, for instance, is making aggressive strides in its MI series of accelerators, and while they haven't broken the CUDA lock yet, an architectural breakthrough or a compelling alternative could quickly erode market share. The other significant risk is the macroeconomic environment. Should interest rates remain elevated for longer than anticipated, the cost of capital for cloud providers and enterprises will rise, potentially slowing down the build-out of new data centers, and by extension, the demand for high-end GPUs. This would lead to a period of digestion, where the stock price would correct to meet the reality. The NVIDIA stock is currently trading at $198.69, marking a significant intraday movement down $8.19 or negative 3.96% as of the latest market data from the NASDAQ exchange on November 5, 2025. This move is a sharp correction, pulling the stock back from its recent all-time high territory and pushing it firmly into the high end of its daily range, having traded between a low of $197.93 and a high of $203.97 today. The prevailing expectation, driven by the